Hi there, this is Rob. Thanks for coming today. I'm excited to be able to get to share with you some ideas about how to beat the indices. Uh, Before I get into it, I need to give you a few moments to review the disclaimer here. Basic idea is that I will be presenting some results. Some of these are back tested, and some of what I'm going to discuss is actual results. But back testing has inherent limitations, but I found it's a great way to learn about the market. Regardless whether we're talking about uh, back tested or actual data, you can't buy a past profit curve, right? So it'd be nice if you could, but no past performance is any kind of guarantee of future results. I'll also note that none of this is individual investment advice. I do provide individual investment advice to clients, but all the concepts I'll be sharing today are general and may not be appropriate for your situation. All right, good enough. Let's get on with it. And here's just a little bit about me. Most of you know me from Quantifiable Edges. I've traded full time since 2001. That's when I began a small hedge fund. Sounds like a long time ago. I've been saying since 2001 for a while. Uh, in late 2019, I closed that fund, and I began managing separately managed accounts with Capital Advisors 360. I made the switch for several reasons. I won't bore you with a long diatribe about that here, but if you're interested, I did discuss this move in some detail years ago on the Quantifiable Edges blog and also at the Capital Advisors 360 website. I will say it's been a great move for me, and I'm much happier working with CA 360 than I ever was on my own. One thing that makes me a bit different from many other investment advisors is my clientele. Most of my clients are traders or former traders who have found me through Quantifiable Edges. And actually, several of them have registered for the webinar here today, so that's great. You guys will know more than most people, do about what I do here. But hopefully, this will spark some ideas for you guys as well. So the primary topic today is how to beat the indices. But let's first discuss whether beating an index is even important. I mean, really, it's just one measure of performance. And in fact, for most of my life, it has not been an objective for most of my personal accounts or for most of the accounts that I run for clients. I generally look for solid, consistent returns with manageable drawdowns. That's generally my goal. That said, there are some investors that view index outperformance as very important. And anyone listening here today must think it's somewhat important. But an example of someone that it might be real important for might be someone in with a long time horizon. So if you're in your 20s and 30s and you've got a long way to go, uh, and you won't be as concerned about perhaps a sizable drawdown happening, and you'd prefer to be more aggressive with your money, it could be important to you. But it could also be important to people that have built up a nice nest egg and want to see it grow. Not necessarily for their entire portfolio, but rather as a sleeve of their portfolio. For instance, someone might say that they want to have 10 or 20 or 30% of their portfolio dedicated to stocks, and they're diversifying the rest of their portfolio in other ways, right? So perhaps with bonds, real estate, commodities, or alternative investments. So if the stock portion of the portfolio only represents a small sleeve and you're well diversified, then beating an index could be, a reasonable goal. Uh, you may note here that I talk about beating an index, but not any specific index. I'm not saying these are my favorite methods to beat the S&P or that these are my favorite methods to beat the Nasdaq or the US government long-term bond index. While some of the concepts I'm going to share will be specific to certain indices, others can be used to beat, any index that you're concerned with beating. Let's talk a little bit about why beating an index is so hard for so many. right? Most people know that the majority of mutual funds fail to outperform the indices that they compare to. In fact, this is what made John Bogle a fortune, right? Rather than trying to beat the indices, he simply noted that most people can't and created cheap ways for investors to simply keep pace with them. So these days, if you're looking at an index like the S&P 500, you'll find that a majority of the index performance is attributable to just a handful of stocks. So many managers remain, 100% invested, and they need to be sure they're picking the right ones, and that isn't always easy. Additionally, most funds and ETFs have sizable expenses to overcome. Still, while most of Wall Street wants you to believe that beating the indices is really hard or impossible, or market timing can't be done, there are several methods that we can utilize to do just that and beat indices and time the market. So market beating method number one here is certainly the simplest. I'm going to share the impact of simply using some long-term trend filters. You might be surprised at how some really simple filtering can make a huge difference over the long run. I decided to use three very simple long-term trend filters. We'll examine performance based on each of them separately. The first is simply looking at a positive rate of change over the last year. So if the market is up over the last 252 trading days, we're in it. If not, we're out. All right. The second filter is a 200-day moving average. So the study will look to be long above the moving average and out of the market when the index falls below it. The last filter is a golden cross. It's slightly more complex than the first two. It's more complex because we're using two moving averages, right? So for the golden cross, we look to see whether the 50-day moving average is above or below the 200-day moving average. If the 50-day is above the 200-day, then the market is in an uptrend. Below it is a downtrend. All right, so simple enough. Let's look at what using these filters would have meant for a few different indices over multiple time frames. All right, let's start with the S&P 500. This first table shows how a $100,000 portfolio would have grown from the end of 1956 until the end of August 2024. The top line shows results if someone simply held the S&P 500 over this entire period, so buy and hold. The next three lines show results using our different filters. So the results also assume when the portfolio is sitting in cash that it's earning interest at whatever the then current 30-day Fed funds rate was. So let's look at a few of the stats. The first column looks at the number of trades. You'll notice that the 200-day moving average is the most active of the three filters. The 1-year rate of change is the second most active, and the filter with by far the fewest portfolio position changes is the golden cross. Skipping over to the exposure column, you'll see that all of them were in the market roughly 70% of the time, as opposed to buy and hold, where the portfolio would have been invested 100% of the time. Despite sitting out the market nearly 30% of the time, all three filters also would have outperformed the S&P. This can be seen both in the net profit column and the compound annual return column, which is shown on the far right. Also notable is that the max system drawdown is substantially less when using these filters. And really, the reason the annual returns are higher is that by incorporating a long-term filter, the portfolio manages to sidestep portions of the largest drawdowns. All right, the next table here, this just assumes that we start at the end of 1971 and go through the end of August. It's using the same assumptions as far as the filters we're using. We see again here that all three filters beat the S&P with lower drawdowns, less time exposed to the market, and higher total returns. Right? We also see that the best numbers are jumbled a little bit since now the Golden Cross is showing the highest rate of return, right? Rather than the 200-day moving average in the previous study. And then lastly, let's look at more recent times. So from the turn of the century until now. Interestingly, the 200-day moving average filter, in this case, hasn't quite kept pace with the buy and hold. Still has managed to contain drawdown quite nicely, and both the 1-year rate of change and the Golden Cross have easily beaten buy and hold. So with the S&P, using some kind of long-term trend filter seems to be a decent idea. It's also a fairly simple way um, and it's also fairly simple to implement. Let's also look at the NASDAQ using the same filters. The NASDAQ was launched in early 1971, so I used the end of 1971 as the start date. Again, all three filters here beat the index. All three filters do so with lower exposure, and all three filters do so with substantially lower drawdown. I also ran the end of 99 to present tests, and again, every filter beat buy and hold, though the order of which filter was best again changed. So let's next go way back and use the Dow Jones. So this study goes all the way back to the beginning of 1928, rides through the Great Depression and all the way up to the present day. Again, everything beats buy and hold. So, when you hear the experts on TV say there's no way to time the market, well, you'll know they're just bad at their job, since just about any long-term filter will beat buy and hold over a long period of time. Of course, there's going to be shakeouts and there's going to be periods of underperformance. There'll be weeks, there'll be months, there'll be years, there'll even be several year periods where you're underperforming the index. But, if you have a long time horizon and you consistently use a filter like one of these to sidestep what might turn into a massive bear market, then there's a good chance you're going to be in better shape over the long run. Leads us to market beating method number 2, right? So let's talk about some long-term models. There's been a good amount of research over the years with regards to long-term models based on momentum, or seasonality, or relative strength. Some of the more well-known work has been done by folks like Med Faber, Ned Davis, Gary Antonacci, and Jeff Peach, who's the principal at Capital Advisors 360, has also done great work in this area, though he hasn't published a lot of it. Of course, I've also done work with longer-term models. Lots can be found in the Quantifiable Edges market timing course. So let me pull a couple of models from there to compare against long-term S&P 500 returns to give you an idea of what you can get with some long-term models. The two I'm going to show are the price action model from the market timing course and the one I referred to in the course as combination number 2 or combo number 2. All right. This chart was created with Realtest, which it's my favorite backtesting software right now. So let's start with the market timing course price action model. It's a simple model that utilizes a long-term trend filter, and then it also has a relative leadership filter in it. And the model switches between the S&P, the NASDAQ, and then cash, right? So since we used the NASDAQ as part of the model, I can only go back as far as around the end of 1971. So that's where I started this study. As you can see, over this time frame, the S&P's averaged 7.9% per year. It's had a max drawdown of about 57%. Meanwhile, the price action model posted an annual return of 15.2% with a 38.8% max drawdown. So the rate of return is a good bit better, and the drawdown's lower, but it's still at a level that might be uncomfortable for some investors, including me. Um, Overall, this model seems to be a pretty good alternative to buy and hold, and it's soundly beaten the S&P over its lifetime. So this is, one example. This is the Combo 2 model you see here in the green profit curve compared to the S&P 500 in red. Um, it also uses seasonal cycles, right? So it's in addition to the price action model, it puts some seasonal filters in there. Its rate of return is a little higher, and its max drawdown is a little lower. So for those of you who are willing to take seasonality into account, this model would seem like a decent option. The compound annual return here is more than twice of what the S&P delivered over the years. That's impressive. Drawdown is again in the higher 30s rather than the higher 50s, so significantly better, but still a little high for some. Of course, if you're thinking, 15.9% is not good enough, you could consider utilizing some leverage with the models, right? So for this next study, I took the Combo 2 model and added a bit of leverage. So of course, when you use leverage, the timing's really going to matter, right? If the model's wrong, it's going to be more wrong. And if the model's right, it'll be more right, but typically not quite as much as the amount of leverage you're taking, right? So let's take a look at results if you were to go 150% invested whenever Combo 2 suggested being either in the S&P or the NASDAQ, right, rather than cash. Combination results can be seen here on the left-hand side. Despite taking 50% more exposure, the annual rate of return only improved from 15.9% to 19.45%. Now that's better, but I'm not sure it's worth the increase seen in the max drawdown, which is now almost the same size as the worst drawdown using buy and hold. So using long-term models is something I like to do, but I don't love using them with leverage. I don't want to be 150% invested for too long a time. And I don't want to be getting whipsawed with that amount of leverage either. So long-term models can be nice options for beating the market um, overall. But all right, let's move on to our next market beating method. For number 3 here, let's talk about using short-term models as an overlay. So most of the models I trade, uh, both for myself and for clients, are short-term in nature. And I like them because you can easily combine them. And if you do it well, they won't often be competing for the same cash in the portfolio. What's interesting about a lot of short-term models is that they do spend quite a bit of time in cash. So using them as an overlay can make sense. Now, you may be thinking, Rob, what do you mean by overlay? Well, when I talk about an overlay, what I mean is that we're using account margin to trade. So to make sure to keep pace with the index, you can load up 100% of the portfolio or the sleeve of the portfolio that you're looking to use to beat the index. You load it up 100% with the index itself, right? Doesn't matter if you're trading the S&P or the NASDAQ or some bond or commodity index. If you want to beat it, buy it and then use your margin to trade. Some people refer to this as return stacking. Essentially, you're taking an independent source of alpha that can attach to existing assets or an existing portfolio, right? Ideally, you'd like the trading performance to be uncorrelated to the index. And if you have a slight inverse correlation, well, that's even better. Here's a little visual to help get the point across. Think of your portfolio as a cake. The overlay is simply the frosting, right? When you combine the cake with the frosting, you typically get a much better cake. I mean, I'm all about the frosting with my cakes. That plain vanilla one on top there, that really doesn't do it for me. Maybe for John Bogle, uh, but not for me. So let's look at some short-term models that could possibly be used as overlays. And we can consider some pros and cons of using these kinds of models, right? I'm going to look at two sample models. The first is a very simple model I call the 5-day low model. And the second is a version of the Icarus short model that I share in the Quantifiable Edges swing trading course. So here's the 5-day low model with all the rules laid out right here. All this is doing is buying the S&P at the close on any day it closes at a 5-day low. All right. It'll then continue to hold the S&P until a day where it closes above the 5-day moving average. All entries and exits are at the close. To execute something like this, and I always get asked this, you can use limit on close orders, right? So to calculate a 5-day low close, you would simply need to know what yesterday's 4-day low close was. To calculate the number you would need to close above today's 5-day moving average, you would simply need to calculate yesterday's 4-day moving average. So we buy a low close and we sell a reversion. And this is a stupidly simple system. But as you can see, it would have worked quite nicely since the beginning of 1992. Uh, the S&P is the line in red here, and the model is the line in green, and they've been just about the same the whole time. It's basically kept pace with the market over that entire period of time. Uh, Another nice thing is it's only in the market about 33% of the time. That's pretty exciting. So since it's only in the market a small amount of the time, what if we were to hold the S&P all the time and then use 50% leverage whenever a 5 low trade triggered, right? Uh, Here's the results of doing that. Here we see that the gray solid area shows the results for the combined model. The orange line is the S&P 500, right? So the combined is holding the S&P 100% and then going to the 5 low trades at a 50%. When we look at the results here, a few things stand out. For one, using 50% margin in the 5 low model does not get you half the return that we saw in the last slide. No longer are you earning interest when you're sitting in cash. Additionally, anytime you're in a trade, you're paying margin fees. The net of this means that the impact is not as great as someone might initially think. So the combined model shows us a return of 10.4%, right? 10.39 you see here on the right-hand side, versus 8.3% for the S&P on its own. And that's better. And if you can beat the market by 2% a year, it may be worth doing. But it does increase risk, right? Max drawdown is now slightly higher than buy and hold, rather than quite a bit lower. In summary, this is my reaction to incorporating a system like the 5 low model as an overlay. All right, profits do increase, but not in a huge way. You are likely to see increased drawdowns. In this example, the max drawdown did not show a substantial spike. Still, this would be a tough system to ride out when you got a huge market sell-off going on. When the market's tanking, you might not want to be levered, but you always will be. During the biggest market drawdowns, you're always going to have increased market exposure, right? So risk seems to increase more than reward increases. Overall, this type of approach is okay, but it's not exactly ideal. The primary reason being that you're increasing risk at the riskiest times. Still, if you're using just a small amount of margin, you could consider something like this. Of course, you may want to consider using a swing trading method that trades in something other than your primary index. You also might consider trading in the opposite direction. The Icarus short model is one that I discuss a version of in the swing trading course. And I also trade it for myself and for clients, a version of it, not exactly this one. But essentially, it looks to short individual S&P stocks that are making new highs and are also strongly overbought in the short term. So it looks for exhausted tops and it then exits those stocks on a reversion lower. The version I'm going to show here holds up to 5 stocks at a time. So the results here assume that interest is being earned on the cash while it's sitting in the sideline. So that helps a little bit with the upside persistency that you see with the green line there. But one thing I really like about this model is its very low drawdown. It's just 11%. You can see that over here, although it's a little bit small. Another positive is that exposure is very low. So the average exposure for this model is only about 14%. Actually, negative 14% since it's going short, right? So someone might think, hey, if I utilize this as an overlay, it might help me reduce drawdown. So let's take a look at that. So here again, the gray line represents someone holding 100% S&P 500 and then using the Icarus short system as a 50% overlay. So that's our combination or the combined stats you see here on the right-hand side. We again see a moderate bump in the rate of return. In this case, we do see a mild reduction in the drawdown, right? Not great. It's not really a big significant one. And the reason for that is that the Icarus short system looks for stocks that are at new highs to short, right? So when the market's selling off hard, there aren't often many stocks that would qualify. So when the S&P is suffering its worst drawdowns, the Icarus system is basically dormant. Therefore, it's not really helping with those drawdowns. Still, conceptually, it's not bad. It does increase profits, and it does slightly lower drawdown. Another thing I really like about this compared to the 5 low model is that while you're using margin, your net long position is never getting over 100%. So when this model gets heavily invested, it's actually reducing your overall market exposure. It can be a nice way to offset some long exposure near market tops. But as we discussed, most opportunities occur in strong markets, so it doesn't soften large extended market sell-offs. Ideally, we'd like an approach that would further reduce drawdown and one that excels when the market is selling off. So as a basic overview, when thinking about using short-term models, they can certainly be useful as an overlay if you're looking to beat the market. You do want to consider when they are adding exposure. Are they adding exposure at the riskiest times? Or are they adding exposure near tops or near bottoms? And consider when they tend to add profits as well, right? Um, and then lastly, if they're uncorrelated or if they're inversely correlated, that makes them substantially more appealing. Something like the 5 low model is fairly highly correlated to the S&P just because it's long only and it's buying the S&P. So you'd be better served to find something that wasn't necessarily just getting levered in the same index if you're looking to reduce risk. So short-term overlay models can be a nice option. But let's look at the next kind of overlay strategies that I like to use, and those are option overlay strategies, excuse me. Since it's an overlay, we're once again investing 100% of the portfolio, or at least that sleeve of the portfolio that we're looking to beat the index with. And then we're looking to add to those returns, right? So of course, this can be any index. It doesn't matter. We then use the margin in the account to set up options positions. Now, to set it up, generally, I like to use spread strategies. They do not require an initial cash outlay as long as you're using a credit spread. So for instance, we might go long one call and short another call, And if the call we short is worth more than the call we purchase, then that'll be a net cash credit to the account. You know, one common spread strategy that we use is calendar spreads. We might short an option that is nearing expiration and purchase an option that is further away from expiration. If there are different strike prices, it can be referred to as a diagonal spread. The strategies that I manage that generate these kind of spread positions do so with VIX options. And I'll talk about one of them a little bit further. Ideally, like any overlay strategy, you'd like to see very low correlation to your index. You'd also like it to reduce drawdowns and generally increase returns over time. Perhaps my favorite option overlay model that I manage is called volatility ladders. Now, volatility ladders utilize credit spreads to generate returns with little or no cash outlay most of the time. That's not a surprise. I already discussed how we do that. It's also primarily designed to benefit from shifts in the VIX futures curve. It can also benefit from VIX levels versus where the options are, the strikes, as the options approach expiration. And lastly, and this is an important delineator in volatility ladders versus many other VIX strategies, vol ladders are built to benefit from increased volatility, right? They're not net short volatility. This is an important point because they can often act as a hedge for an equity portfolio. Typically, the strategy will be both long theta and long vega. Right? So long theta means it's going to benefit from time decay. As the options get closer to their expiration, the strategy is going to benefit. Long vega means that they'll also benefit from a rise in volatility. So under most circumstances, vol ladders will benefit from a spike in the VIX. I'll also note that they've had a very high historical win rate. High win rates for an overlay are a positive because you don't need to sell your index position to cover losses. You know, if most of your trades are winners, you don't need to keep readjusting and selling out of a little bit of your index so that you're not on margin. It's nice to be able to take the winning cash and add that to your index position instead. Just a little bit about how the volatility ladder strategy has performed over time. The ladders first went live in my own and some select client accounts at the start of 2022. And then a couple months later, we added a lot more clients to it. And as it turned out, that was pretty good timing. 2022 was a volatile year. It had several spikes in volatility. We also saw the VIX futures curve invert multiple times. And this all created plentiful opportunity, and the model posted strong gains in 2022. And then near the end of 2022, and as we got into 23, the new bull market emerged, and volatility just kept declining steadily. And there were no real scares in 2023, and very little in the way of opportunity or profits for volatility ladders. Still, because of the way we structure them, they were able to scratch out some small net gains, right? 2024 was also mostly quiet until the last few months. You know, we saw the big VIX spike in August, and a VIX above 20 for a lot of the last several weeks. In fact, it's just right at 20 right now as I'm talking. This has led to some increased action and some increased profits versus what we were seeing last year in 2023. From January 2022 through September of 2024, correlation with the S&P 500 for this model was just 11%. And I really like this strategy because it tends to excel during difficult market times, and it's managed to tread water and not cost anything during times that the market's rallying, right? So that's just about the perfect combination for me. Well, I'd love to be able to share some more results on this strategy. Compliance at CA360 prohibits me from doing so in a forum like this. So if you'd like to learn more about the vol ladder strategy at Capital Advisors 360, I'd be happy to talk one-on-one, or you just send me an email. Conceptually, for those looking to trade an options overlay strategy on your own, you generally want to find something that utilizes credit spreads, has a high win rate, and a low correlation to your index. You get those three things working in your favor, you got a good chance at having a beneficial strategy. Now, if you haven't guessed, market beating method number 5 is simply a combination of the approaches we've already discussed. If someone were to come to me and say, "Hey, I want to beat the S&P 500 over the next several years," I might do something like the following, right? We would take 100% allocation to a long-term market timing model, or multiple long-term market timing models, right? Like the Combo 2 model I discussed. At CA360, I manage something similar to that called Momentum and Seasonality. Jeff Peach has a nice model that I use that trades the S&P as well. So we'd use a long-term market timing model and then add an uncorrelated option strategy over the top of that. So perhaps volatility ladders or perhaps something else. And then we can also do a small overlay allocation to short-term models over the top of that, right? So it's easy to mix it up, but the best approach is actually using multiple approaches, and that's what's going to help you beat the market over time, or give you the best chance to beat the market over time. Excuse me. So in summary, my 5 favorite index beating methods are: number 1, use long-term filters. Number 2, add to that a little bit and turn them into long-term models. Number 3, use short-term models as overlays, either over the index itself or over your long-term models. Number 4, use option credit spread strategies as overlays. And then number 5, combine multiple models. A few words about Capital Advisors 360 before we get to the Q&A portion of the webinar. CA360 was originally established as eSound Capital Advisors. This is back in 2011 by Jeff Peach. And I've known Jeff a long time, and I decided to join him in 2019. Completed all our registrations and everything right at the start of 2020, and I run strategies for clients in separately managed accounts. So it's not a fund. There's no fund accounting. There's no performance fees like you used to have with the old hedge fund. Most of the models I run are available through Interactive Brokers. I do have some clients at Schwab, and there are some models available there as well. Now, if you're not familiar with separately managed accounts and how those are structured, here's just a few details for you. You would need a $100,000 minimum account size, and for us to manage some of the strategies that I run, it would actually have to be 150,000 or more. Like I mentioned, Interactive Brokers is the primary custodian that I use. Schwab's also available for some IRA strategies. Basically, what you would do is set up an account with Interactive Brokers, and then give us trading permission on the account. Right? So it's your account. You can put money in. You can take money out whenever you want. And then we just have trading permission on the account. Management fees are 1.75% up to $150,000. Once you get over $150,000, then reduced fees start to kick in. And I sometimes am able to offer reduced fees if it's overlay only type accounts. So an account that just holds an index, doesn't do anything else, and I put an overlay on it, or if you're say just holding bonds in the account, and we put an overlay on that. I have to say fees are negotiable because of that, but really they're only negotiable if you're a member of my family or Jeff's family. Another nice benefit for people that I run accounts for that are also traders is that you can get a Quantifiable Edges Gold subscription at no charge. So anyone that has an account with me gets a QE Gold subscription, and it's a nice way to hear my market thoughts or see what I'm considering every day, and you'll have some understanding of why your account is either heavily invested or lightly invested. Uh, and as I mentioned before, most of my clients are traders. So a lot of them will allocate a sleeve of their portfolio to me. We do offer a complete portfolio coverage for other clients, um, but it's really, up to you whether it's just a portion to fill in a gap in your investing, or whether it is a complete plan and a complete um, management of all your assets. All right, that's all I have for today. I hope you learned something here. I hope you got some ideas that you can go and work with and research with. And if you want to reach out to me for any reason, whether it's to follow up on some ideas in here, or whether you want to learn more about Capital Advisors 360, or whether you want to learn more about quantifiable edges, don't hesitate to contact me. My contact information is below. It's normally best to email and we can set up a phone call, but if you want to try just call me out of the blue, um, I might answer, I might not. If it's a strange number, sometimes I don't, I'll be honest. So uh, feel free to reach out. I look forward to talking to you, and I hope you benefited some from the webinar today. I'm going to stop the recording, and I'll be happy to answer any questions from here on. All right.